Welcome to another version of the Entrepreneurial Blueprint podcast. My name is Dr. Jake Latimer. Here's my business partner, Rick Yancy.
Howdy.
Today, we're going to do something a little special for everybody. We're doing one on the recent One Big Beautiful Bill that just passed. And what we're going to try to do is we're going to try to unravel some of the myths or bust some of the myths that are out there. Rick, you and I were just talking just moments ago. It's very important to be very careful on where you get your advice from out there.
Yeah, I mean, whether you're on X or TikTok or Facebook, all these social media things, they're surrounded with people that have agendas of their own, and they put out their own spin of what tax legislation really is saying. And you got to be careful because not all the stuff that's out there is true.
That's right. So today we're going to discuss 50, I would say, topics out there that are circulating pretty high level stuff. And we're going to go one by one, and hopefully you guys will find this just as informative and as fun as Rick and I do.
Absolutely.
So the claim number one on the One Big Beautiful Bill, X says 2017 tax cuts are permanent. Is that truth or is that fake news?
That is the truth. Yes, that was the great thing about this bill is that Congress has permanently put in place the new tax laws that were put into the TCJA, which means brackets stayed down. Some of the good cuts that were in there were made permanent, and there was an expansion on some good things as well.
That's right. That's the truth. So clients, you need to plan now.
Yeah. So another big claim that we're seeing here, White House on X is claiming this is a win for the middle class. Is that true or false?
It's kind of a half truth, Rick, to be honest with you. Income does get a little bit of a cut, gets $500 to $1,500, but the top 1% gains $61,090. Okay. So it's not just for the middle class. So it's kind of a half truth.
So is this going to lead to a lot of people saying this was a tax cut for the rich?
I'm sure that's a lot of information circulating out there, and one can certainly argue that.
Yeah.
So the next one is, and you've heard this, Rick, is no tax on Social Security. Is that truth or is that fake news?
This is one of those fake news. Okay. So the way this really works is, so there is a deduction, $6,000 that they're going to get on their taxes. But right now that's planned to be phased out in 2028, and there's income phase outs as well. So you may not get that deduction if you make too much money as a senior. The phase outs are somewhere around $75,000 if you're single, $150,000 if you're married.
Very good. Very good. Fake news, people. So seniors, if you have issues with that, feel free to reach out. We'd love to help you.
Yeah. Another big one on X. Tipped workers are getting the big break. Is this true or false?
It's the truth.
All right.
You get to deduct $25,000 all the way through 2028. And you hit on it just a moment ago, Rick. There's a phase out provision, and it's going to phase out in 2028. Also, there's a phase out if your income is at $150,000. So it's great for restaurant clients.
All right. So if my income is majority tipped income, I'm going to get $25,000 of that free?
That's correct.
Wow. Okay.
Overtime pay is tax-free for all, Rick.
Sounds too good to be true, and it is. Sorry, it's fake. You are going to get a deduction, much like the tips. You're going to get a $12,500 deduction on your overtime. So if you work a lot of hours and maybe you make $100,000 and half of that is overtime pay, you're only going to get $12,500 excluded off of your taxes. So the rest you're going to have to pay taxes on.
Yeah, and it phases out at $150,000.
And if you make $150,000, I'm sorry, you don't get any of it.
Yeah. So fake news, guys. Update your withholdings.
Yeah.
Okay. This is one I like. Gambling losses are fully deductible up to your winnings.
So this is a big thing. If you're a professional gambler, you've always been able to write your losses off. I'm not much of a gambler.
I'm not either.
I'm just not much of a gambler. That's the conservative in me that's like, the house wins most of the time. But we do have some clients that like to go over to Louisiana and gamble and do some different things, and they write off some pretty sizable chunks of their income through the gambling losses that they do in the casinos. This is fake news.
Yeah. So what I want people to understand is this is, and not to get too granular, but this is still an itemized deduction on Schedule A.
Yeah.
So assuming that you're itemizing, it doesn't kick in until 2026, people. And so let's just say, for instance, you have 100,000 in wins, you have 100,000 in losses, you're still going to be taxed on 10,000.
Yeah, it's 90%. It's a limitation. You no longer get 100% up to your full winnings, which used to be the rule.
Correct.
You could deduct your losses all the way up to your winnings. But if you had more losses, you couldn't take them. Correct. Now you're limited to 90% of your total winnings. So if you have losses, does that mean I get to deduct my losses? No. Also, you have to itemize as well, guys. Yeah, and you have to itemize. That's so
if you don't itemize, regardless, it's not going to work.
That's right.
Okay.
All right.
Gamblers owe taxes even if they break even. Says zero profit gamblers pay. Truth or fake news?
That's the truth. Unfortunately, you are gonna owe, because this new limitation, the 90% rule, means that if you make any money winning, then you're going to pay at least money on 10% of your winnings, at least.
That's
okay.
Right.
And if you have no losses, then you're going to pay it on all. But if I make $50,000, I hit the jackpot $50,000, and I have a few losses, I can only take 90% of that. So that's $45,000 in losses I could take. I'm going to pay taxes on $5,000.
That's the truth, guys. So pro gamblers, you need to strategize out there. Okay.
Yeah. Yeah. All right. So, is this going to kill the gambling profession? So there's a lot of people saying that with this new tax rule, gambling's going to die because, hey, I don't get to deduct all my losses now.
I would call that a half truth, Rick, to be honest with you. Look, man, if that's your passion, if that's what you enjoy doing, I think while the deduction is not as robust, I think they're still going to go out there and do that. Just like we talked about, 90% cap on that. And pros can adapt and with offshore accounts or lobbying, things like that as well.
I mean, at the end of the day, why do people gamble? They want to win, right? And so this is not going to stop people that are really into, I think I've got a good shot at winning some good money. So no, it's not going to kill the gambling industry, but it might change it a little bit.
A little bit. Yeah. Gamblers deduct 100% of related expenses. X says gambling expenses are fully deductible. Truth or fake news?
No, and this is not your losses. This is your normal deductions that you take as a professional gambler, that I can take all of my deductions. Nope. So just like with your losses, all of your deductions, this could be your travel, this could be your meals.
That's right.
All that stuff. Guess what? Now it's 90% of that is going to be capped. And that goes right along with your losses. So the total amount that you're allowed to write off against any of your winnings is 90% of all expenses.
Yeah, even if you're a pro gambler out there.
That's correct.
Good point, Rick. Good point. So keep your records. I can't emphasize that enough. I know Rick has the same sentiments. View it as a business and keep all of your expenses and document.
Yes, all the time. So staying on the gambling. So does this make gambling income reporting easier? According to X, it says this is going to make it less of a hassle to track all of your stuff, especially for the casual gambler. What do we think?
That's true. They're going to repeal the $600 Form 1099-K threshold, so there should be fewer audits for smaller bets.
Okay. So for my penny slot people, they're not going to have to worry about it as much.
Yeah. Look, the reality is, though, if you have earnings off of it, you should still claim your income, all income derived, whatever. With that being said, you won't have to worry about the 1099 can be issue.
Right.
All right, let's pivot a little bit. For the child tax credit is going to double to $4,000, Rick. That's what's on X right now. Is that true? Or is that fake news?
Man, I wish. I've got 3 kids of my own and I could use that money, but no, that's not true. The child tax credit is only going up to $2,200. So it's going up from $2,000. And that was TCJA that actually increased it before that. but it's only going up $200, and the refundable piece for those that get a refund is $1,700. So it is fake news.
Fake news. Fake news.
Standard deduction, right along with that, is going to go up for married couples, $2,000. So as a married person, are you getting an extra bump in your deduction?
That's the truth. That's the truth. It's going up to $31,500 for joint, plus $2,000 through 2028. Okay. So it's very important to optimize your deductions, and especially if you itemize. But that threshold is going to be much higher now.
Yeah. Well, and is that going to then make it harder to itemize?
Absolutely,
it is.
Absolutely. This is the one that I really like the most. Okay, this topic. But there's information out there that the SALT cap was going to be eliminated. Okay, is that true or is that fake news?
And I wish, look, hey, we pay enough in taxes as it is, and we should get to, I think we all feel like we should get to deduct as many of those taxes as possible, whether it's sales tax, property tax, any of the taxes that, you buy a vehicle, vehicle tax. Unfortunately, all they did is they raised the cap. So TCJA came in and said, we're going to put a $10,000 hard cap. That's all you can deduct.
Yep.
Well, that's really hard for you if you live in a state like California or New York and you're a high income earner and you have a property there. Let's say you have $1 million house and you pay a lot in property taxes there and a lot in state taxes. You hit that 10K cap pretty hard. Okay?
That's right.
And that's all you're allowed to do. Well, what they did with this big beautiful bill is they raised that 10K cap to $40,000. So that's going to give you a huge break, right?
Yeah.
So if you're one of these people that's in one of these higher tax states, you're going to be able to deduct more of those taxes on your itemized deductions. But again, you must itemize to be able to take this break.
Yeah, absolutely. I think, that will allow more people to itemize. I know a lot of people were phased out when they had that 10,000 cap. So this will now push some people over that threshold now.
Yeah, because it was sometimes it's hard to itemize if you're stuck at that $10,000 cap, because that means your only other deduction is charitable contribution. So that means I have to give a lot of my money away just to be able to itemize, right? This unfortunately does phase out in 2028. So 2029, we could go back to the 10K cap. There could be a new change.
That's right. Go ahead.
So along with the TCJA, there was the small business QBI deductions and other things that were put into place. Is that all going away?
It is not. That is fake news. That 20% deduction is permanent now.
Okay. Perfect.
So expensing it has been expanded. So business owners, reach out to us. This is one of the areas that we specialize in. Love to help you guys.
Yeah, and this is if you have an S corp, a partnership, maybe you're just a Schedule C filer with with a business. That 20% that you got to take over and above your standard deduction is there, and there's better news to come.
Yep, that's right. All right, so claim number 15, deficit cut by $2 trillion. White House says $2 trillion deficit cut. Is that truth or is that fake news, Rick?
I guess it depends on your math, right? I think most of the outlets out there, including the CBO, are saying, no, not really. So over the next 10 years, they're thinking that deficits will rise anywhere from $3 to $3.8 trillion. Of course, this has to do with, I think, revenues are going to go down. We'll see. When the TCJA came out in 2018, they said the same thing. Revenues are going to go down. Well, they actually went up. So we'll see. But based on the current projections, no, it looks like the deficit's going to keep going up.
Yep. So fake news. Watch your loan rates out there.
All right. So what about car loans? I mean, you used to could deduct the interest on your car loan. That was a big thing in the 80s when we had high interest rates, and I went out and bought a car. Can I now take a car loan deduction?
You can. If it is a U.S. made car, up to $10,000.
What about a Toyota? Can I do a Toyota?
I don't believe so.
What about if it's made in the Tennessee factory?
That's a good question.
It's made in the U.S.
That's a good question. It should be.
Yeah.
It should be. All the way up to 2028.
Yeah. So check your stickers when you buy your cars because they have that made in the USA thing.
That's right.
And if you are buying a new vehicle in the next year or two, you could get a good size deduction on it. But yes, it does have to be made in the USA.
That's right. Bonus depreciation. A lot of people are going to like this. Is 100% X says full bonus depreciation is now forever. Is that true or fake?
Boy, man, I wish that this was true. And it kind of is, but it's not really permanent. It's got an end date right now. But yes, it is going to stay in place. 100% bonus depreciation on any new acquisitions for businesses is going to be. So you get to write that new vehicle off. You get to write that new machine that you buy off. But it phases out currently in 2031. So it's not a forever thing yet. It's not coded into the code yet forever. Yep. But it is still in place.
Yep. So if you need help with depreciation and accelerating your depreciation, feel free, give us a jingle. We'd love to help.
Absolutely. So here's one for a lot of people because this was a big change in the TCJA. It doubled in 2018 from right around $5.5 million to a little over $11 million.
I remember that.
The estate taxes, the exemption on it. Now we're hearing that it's been doubled again. Is that true?
That's true. $15 million per individual.
Per individual, not
yes.
per married filing jointly.
That's correct. Permanent and inflation adjusted.
So every year that number is going to go up.
That's correct.
Wow. Okay. So if you don't have an estate yet, or if you do have an estate, you might go check your plan docs because you might need to change things, especially if maybe you have life insurance that's set in place to cover your taxes. You might need to adjust your life insurance based on this new plan.
That's right. No taxes on tips for high earners. X says that tipped workers get breaks. Is that the truth or is that fake news, Rick?
No, we talked about this earlier. It's fake. If you make more than $150,000, you don't get to take the tip exclusion on your taxes. That's right. So this is really geared, and this is why I say when they talk about was this a tax cut for the middle class, it was. Okay, so if we think about the middle class, most experts put the middle class anywhere from $50,000 to $100,000 as a married filing jointly earners. If you're making more than $150,000, you're considered in the upper class, and you're not going to get to take this as a deduction.
Yeah, Rick, you and I were talking the other day, and I want to kind of hit on something, right? Because people are going to try to get creative out there when it comes to this. And we talked about, individuals who, let's just say they're cutting somebody's hair. Mm-hmm. And they might say, instead of being a $20 haircut, a $30 haircut, whatever that is, I'm going to charge you $5, and then you're forced to tip, right? Look, being creative, I can appreciate someone trying to be creative at the end of the day. But if you really think that's going to pass mustard, it's not, guys. Well, you can't change your fee structure.
A forced tip is not a tip because a tip must be voluntary. Then that's by definition under the code.
Yep.
Is that it must be a voluntary payment made by a customer. So if you say I've got a $30 haircut, now it's $5, but you must pay me $25 in a tip, they're just going to consider that part of the sale, and that won't be included as a tip.
That's right. So just be careful, guys. Lot of bad information out there, whether it be circulating on TikTok, X. We kind of hit on it earlier. But it's great to be creative, but make sure you stay within the legal parameters. And I can tell you that's one they're going to harp on. It's not original. Everybody's talking about it. You will get caught. Don't do it.
Yeah, okay? I mean, if you filed taxes previously and you have a history of my W-2 wages are X and my tip wages are Y, and suddenly those are flip-flop, that's going to red flag you for an audit big time.
That's right.
All right. So along with this, some people, not a lot, are part of the AMT category. AMT.
What does AMT stand for, Rick? Can you let the end user know what that stands for?
Okay, so AMT is the additional Medicare tax that people pay. You basically are a high wage earner, and so you're subject to additional taxes. It's also additional minimal tax. So people that make a lot of money but have a whole lot of deductions.
Yep.
So let's say you make $1 million, but I have $800,000 in itemized deductions. And so I write it all off. And so I only pay taxes on the $200,000. AMT will come in and go, stop. You're taking too many deductions.
That's right.
There's a minimum floor on the amount of million should pay, and you're going to pay that amount, not this amount. And so,
so if you're single, it's $88,100,
correct,
right? And $137,000, if memory serves me right, for joint filer. Is that correct?
Yeah, that's right. And so, so is it a permanent thing that's going in place right now? It is.
Yep.
Right.
Yep.
But just be careful with AMT because there's new qualifications on what qualifies as an exclusion on AMT. Make sure you get with a tax preparer that helps you, especially if you're a high earner, that you make sure you understand what is and isn't going to be included in your taxable income.
That's right. That's right.
Go ahead.
Moving expenses are deductible again. That's what X says. Moving costs are deductible. Is that true or is that fake news?
No, not in the least. So this is another 2018 change that occurred. Prior to 2018, anybody that moved, as long as you moved more than 50 miles away from your current position or you moved for a new job, you could deduct your moving costs on your taxes. That went away in 2018.
Yep.
What they have done is at that time they had an exclusion. If you were in the military, you could still deduct it. They've made that kind of permanent that the military is always going to get to deduct it.
Yeah.
But no, moving expenses are not deductible.
That's right. Fake news for civilians out there, guys.
That's right. That's right. Okay, itemized deductions are being capped. So X says itemized deductions are being limited. Is this true or false?
That is true, Rick.
Okay.
35 cents per dollar for high earners.
Okay, so again, I go back to my $1 million earner, right? So it's going to be hard for me to deduct $800,000 on my taxes because I'm going to be limited up to 35% of my total income on my itemized deductions.
That's right. That's right. So make sure you review your itemizing.
All right.
All right. So personal exemptions restored. X says personal exemptions are back. Is that truth or is that fake news?
So this was personal to me because when you have a family that's bigger than 4 people, and that's the standard model in the United States, that was kind of the break-even point. So personal exemptions, if you had more than 4 people in your family, the increased standard deduction was a wash. But if you had 5 or more people, you lost money by excluding the personal exemptions. Well, guess what? They're back.
Yep.
Personal exemptions are back. It is the truth. It has been reversed, and that is going to help larger families. So if you're a family 5, 6, 7 people, not only are you still going to get that standard deduction, but now we have personal exemptions that are going to help you. Now, there is going to be some, phase outs, I'm going to guess, because there used to be phase outs on it. Yep. We haven't seen what those are yet, but this is the truth there that personal exemptions are coming back.
So people might want to update their withholdings on that kind of stuff.
Absolutely.
Right?
Yeah.
Yep.
So, what about, we keep talking middle class and upper class. What about the low income folks? X says the low income are getting nothing. Is that true?
No, that's not true at all. That's fake news, guys. The child tax credit that has went up, tip deductions, that's going to help. But program cuts will hurt though.
Okay. So that's the SNAP stuff, Medicaid stuff.
Yep.
But be careful on some of that. There's a lot of fake news on that stuff too.
There is.
Because the people that it's really going to impact are really going to be the undocumented people here.
Yeah, guys, look, I can't emphasize it enough. Look, man, we're all entertained by what's on TikTok. And obviously you're probably watching this right now, whether it be a YouTube short, TikTok, X, whatever platform it's out there. Just be careful that, the information that you're receiving, that you only act on information from qualified people. Okay.
Yeah. Watch out for the sensationalists because it's usually politically driven. We're not here. Politics is not our thing. We're here to help you with your taxes.
That's right. That's right. We're very neutral on that regard. Capital gain rates are going to increase. That's what they're saying on X right now. Is that true or is that fake news, Rick?
Well, that is about as false as it can be.
Yeah.
Okay.
Yep.
Everything is staying exactly the same way it is. So the highest rate is still 20%. Outside of specific capital gains that could be in the 28%, which is your collectibles. So you have collectibles that are at 28%, but your stocks, your typical long-term capital gains, sales of assets, the most you're ever going to pay is 20%.
Yep.
Okay, charitable deductions. So X is saying there's no longer a cap on your charity. Okay, so it used to be you had up to 50% is all you could give of your total income to be able to deduct. Is that true?
That is true, actually. However, there's a 35% valuation cap for high earners, though. So that still is applied. And we talked about that just moments ago. But it is true, which I like that. I like that. That there's no cap now for people who want to donate on charity.
That's awesome. So if I'm a lower income, maybe I'm $200,000 and maybe I can live on $50,000-$60,000 and give the rest of it away. I can take that all as a deduction.
That's correct.
That's great.
Yep. Gambling deductions for non-itemizers. X says non-itemizers deduct gambling losses. Is that true or is that false? We've talked about it already a little bit, but
yeah, I mean, we've already kind of blown this out. It's not true. You must itemize to be able to take your gambling losses, and again, 90% of your winnings. It's a cap.
Yep.
So it's false. Child care credits for business. So if you're working for a company and they pay for your child care, they get a deduction for that. So there's X is saying that the credit that they get to claim is boosted. Is that true or false?
That is true. It's a 40% credit or a 50% for small biz up to $600,000.
Wow. So if you are working for a good sized company, this is a good time to lobby your company. Pay for my child care and you get a huge deduction for it.
That's right. The GILTI tax rate rises. X says global income taxes are up. Is that true? Or is that fake news?
So this is true. So guilty taxes. So this is where you're talking about most of this is going to be for your multinational corporations that do business around the world. And, you know, in the United States, we have what's called global taxes. You pay taxes on every dollar you earn globally, not just
worldwide
within the U.S.
Income. Worldwide income.
So for those multinationals that are doing business in China and Russia and different places, their tax rate is going to go up to 14%. That's an increase from 10.668%. So it is going up about 3.5%.
Yep.
All right. So the big one that we used to get and people still talk about is if I sell my primary home, is that still going to be no tax? And so X says all home sales are tax free. Is that true or false?
That is false. Nothing has changed on that, people. I wish those numbers would be adjusted for inflation because it's been like this for a while. If you're a single taxpayer, it's a $250,000 exemption, $250,000 exemption on the sale of your primary residence, assuming you've lived there 2 of the last 5 years.
That's right.
If you're married, it's going to be bumped to $500,000. But that's been, God, as long as I've been doing taxes almost, Rick, it's been like it there for a long time. Unfortunately, they haven't adjusted it for inflation. I wish they would. But as far as it completely going away and there not being a limit, that's fake news out there. Nothing's changed. It's $250,000 for single filers and $500,000 for married filing joint.
Yeah, and that's the capital gain. So if you sell your house for $1 million, but you bought it for $500,000, your gain is $500,000. You still run under the exclusion.
Yep.
Right.
Yep. So I want to talk about something real quick, and I've seen a lot of information that's been circulating out there about this. The EV tax credits, that they're expiring, okay? Is that true or is that fake news, Rick?
Well, electric vehicles are coming on. Lots of new people are in play with it. You know, Tesla's got all the new stuff out. It's fake. Okay. So the credits are still set to end in September of this year. Okay.
And that'd be a good time. If you want an EV, now's a good time to buy.
If you want to get that EV credit, if you want that new Tesla and you want to be able to write it off on your taxes, September is the last time to do it.
Yeah, guys, look at seriously. And I'm not, a proponent for one that necessarily wants an EV, but if you want an EV, if that is your thing and you're using it in the business, you could essentially take a tax credit for that EV credit, as well as get bonus depreciation for that vehicle as well, up to 100%.
That's right.
So, work with your tax professional, whoever your accountant is, your CPA, your EA, your tax strategist, whoever that individual is, work with them. Make sure that vehicle, those vehicles qualify. And make sure you act now because, like you just said, that's going to expire in September of this year.
Yeah. So X is now saying that any new factory built in the U.S. will be fully deductible. Is that true?
That is true, right there. Full deductions all the way through 2029.
So Trump was serious when he talked about he's bringing manufacturing back to the U.S.
Apparently so. Yeah. Apparently so.
So that could mean more jobs. That could mean better things for the economy because it's being spent here to build the factories and stuff. So yes, look out if you're in an area where there's a lot of manufacturing. Don't be surprised if you don't see more factories going up.
I agree. Pass-through deduction rises to 23%. A lot of information out there on X says that the pass-through deduction is rising to 23%. Is that true or is that fake news?
That's fake news. So this goes back to the QBI deduction we talked about earlier. It's 20%. It's staying at 20%. We aren't getting a bump up for that. It's going to be 20% from now until they make another change.
That's right.
So X says, and this is from Chaos and Roswell, 5% wager tax. Is there a wager tax now?
No, it's fake news. There's no 5% excise tax in the one big beautiful bill, unfortunately, guys. Once again, be careful what you have out there.
All right.
So seniors get a permanent $6,000 deduction. X says that seniors can deduct it permanently. Is that true or is that fake news?
No, that's fake. Okay, so this goes back to, we talked about this other Social Security stuff and all that. It's $6,000, but it's set to expire through 2028.
Yeah.
Okay.
Guys, one of the things I want to hit on here and I want everyone to understand is it's not very common when something's permanent.
Yeah.
Okay. Most of these laws, when the new administration comes into play, they will only last for a specified period, and then they're set to expire. That way, they don't step on toes for the next administration that comes into play. So when you hear things that things are permanent, they can be.
Yeah.
I'm not saying that they're not. I'm just saying that it's not very frequent when that does happen.
Yeah, I mean, the code it changes all the time. It's the reason why it's as big as it is, right? And so tax laws change almost yearly, and so nothing really ever is permanent.
Yep.
Okay, what about the tax brackets themselves? X is saying that every bracket is getting a cut. Is that true?
No, that's fake news, guys. The rates are permanent. They have not been reduced from the TCJA, so they're the exact same.
Okay.
So I know we've talked a lot about gamblers, and we're going to hit it one more time. So the casual gamblers to avoid taxes. X says casual bettors dodge taxes. Is that true or is that fake news?
So it's kind of true, but not really. So again, this goes back to the forms aren't going to be out there like they used to be. You get a form for everything, right?
Yeah.
Now, because of the repeal of the 1099 requirements, you're not going to get a form for everything. And so now it really is going to be on the gambler to track their income and stuff like that. Look, if you make money, you're responsible for reporting that income.
That's right.
Okay. So, but there's not going to be as much reported to the IRS.
And from their perspective, I can tell you what drove this. They didn't create this threshold for people to, skirt the paying taxes. They did this because it was turning into an administrative nightmare.
Yeah, I mean, because if you think about it, it's so easy. If you spend a day just gambling, you might win $600 and lose $1,000, but they got to issue you a 1099, even though you lost.
That's right.
Okay.
That's right.
All right. So we talked about this, the low income earners, Medicaid cuts. Okay. X says Medicaid cuts are tax neutral. Is that true or false?
No, that's fake news. Look, 1.1 trillion cuts reduce low income deduction. So it's absolutely fake news out there. You got to be careful, especially when you have these two parties that are going back and forth. You don't know what to believe. That's why I say it. And I've said it earlier, I'll continue to say it. Make sure you get with someone who is trained in this, that understands the tax law, and has a neutral position and truly acts as a fiduciary.
Yeah.
That's important.
Yeah.
All right. Semiconductor tax credits boosted. X says chip makers get bigger credits. NVIDIA, Intel,
Yeah.
AMD.
Yeah.
Is that true or is that fake?
So, honestly, it's true, and there's a reason for that. If you know anything about these companies, most of the stuff is made in China. right? That's where
China.
where most of the semiconductor metals are, right?
That's right. That's right.
And so what is Trump trying to do? He's trying to bring all that manufacturing back to the U.S. And by doing so, he's giving them a tax credit. We want you to bring all the chip making back into the U.S.
Right.
And so I think it will have an effect on our chip making and all of that.
Right. It's to make us more competitive and
Yeah.
to create more jobs here at home. So I think the logic behind it makes a lot of sense.
Yeah. White House X says $10,000 extra per family on your take-home pay. Is this true or false?
No, that's fake news. Look, guys, and I think anyone with half a brain can realize that, that's a very large and egregious number. Typically, though, families are going to gain about $1,430 off that. Okay, not $10,000. So
and that's through just tax savings, right?
That's right. That's right.
That's not actual cash that you're getting in your paycheck. This is you're going to save taxes on taxes going forward.
That's right. That's right. Okay, so R&D credits, they are eliminated. X says that R&D, research and development credits, are gone. Is that true or is that fake, Rick?
Well, come on now. If we're doing all these expansions on all these other credits, do you think we're going to stop giving people innovative credits for research and development? No. Fake news. Come on now.
Yep.
The R&D credits are still the same. Nothing's changed. However, R&D credits take a long time to get processed by the IRS. It can take a couple of years to file a return claiming that. And if you're a C Corp, getting that applied to taxes you owe. If you're in a pass-through entity, applying that to your personal taxes so that you can get a tax credit or a rebate on it. The new bill is expediting some of those refunds on the credits.
That's great. That's great.
So what about self-employed people working from home? X says you're going to get a bigger home office deduction. Is that true or false?
Yeah, that's true. Actually, it's simplified deductions for self-employed people, up to $2,500. So yeah, that's true.
All right.
Yeah.
All right.
All right. Back for more gambling winnings. Gambling winnings are tax-free for low income. X says low income gamblers pay no tax. Is that true or is that fake?
Oh, okay. So this is again, it's fake. It's back to the idea that you're not going to get a 1099, so you're not going to report your income. And that's just not true, guys. Okay. So if you win something, you're supposed to report it, whether you get that 1099 or not.
That's right. That's right. What is it? Code section 61 says all income derived from whatever sources should be reported as taxable income.
That's right. That's right. So nothing has changed on any of this. Okay. Okay. X says corporate tax rates are being cut to 15%. Is this true or false?
Man, I really wish that was true. I'll be honest with you. I know that there was a lot of talk under the Trump administration, Rick, that if they were a manufacturer here, they were going to drop that down to 21% or from 21% down to 15%. If they were non-manufacturer, they were going to try to get that pushed through to 20%.
Yeah.
However, that didn't pass the Senate. So everything is locked in, 21% flat rate, nothing changed.
But it didn't go back up to the 35 that it used to be.
This is true. This is true. All right. So student loan interest deduction. That's going to double. That's what X is saying out there. Is that true? Or is that fake news, Rick?
Well, I mean, this goes right along with those that think that student loans are going to be forgiven. It's fake. It always has been and always will be. It's staying the exact same. $2,500 is the most you'll be able to take. Now, personal opinion, we get to take loan interest deductions off our business. Now we're getting to take a car interest deduction. Kind of feel like student loan interest should be fully deductible too.
I think it should too. I think what it does, I think this bill's got it completely wrong.
Yeah.
You have these phase out provisions. You're a single paying taxpayer. It's $80,000. If you're married, filing joint, it's $165,000. The problem with that theory is you're telling people to go to school, go get educated, so they can go get a better job or better career. Okay.
So they're going to make more money.
So they're going to make more money. That's the logic behind it. But now you're going to penalize those individuals when their AGI hits a certain phase out provision and not allow them to take that deduction. I'm sorry, but that's just disconnect by our government by not helping the taxpayer out who has busted their rear and is paying their loans to be able to deduct the student loan interest. I'm sorry.
I feel the same way.
Yeah.
If we're gonna allow other people to write certain interest rates off, why not something that's going to improve someone's life
and improve the community as well?
Absolutely.
Right. Better jobs out there.
So X now says that the energy credit, so this would be like your solar, your winds, the nice windows that you can put into your house.
Yep.
They say that's forever now.
Once again, Rick, like we talked about, man, hardly anything is permanent out there, guys. It's fake news. And so it's going to be extended till 2029. But it's not permanent. There will be a point where they say, look, it becomes so common that everything everybody's doing is energy efficient out there that they will no longer provide you with a credit for it. So I am really kind of surprised that some of this didn't expire, to be honest with you, because a lot of windows, a lot of AC units, a lot of things out there are energy efficient now. So I think that threshold when it expires in 2029, I don't think it will be renewed after that, or not long after that.
It's funny. I've actually explored this. I'm actually putting solar in at the house.
Oh, are you?
I am. And my personal tax issues have always been I always owe every year.
Yeah.
But the tax credit I'm going to get off of this, because I'm doing it, is going to allow me to wipe off my tax bill this year.
Love it.
Because of the way the tax credit works. Depending on what you're putting in, you can get 30% of the price that you take off. So, typical solar somewhere between $50,000, $80,000. I'm going to go with the Tesla brand because I really believe in their model. For a lot of people, that's $15,000 to $25,000 in taxes that you could write off.
That's lovely.
Now, you don't get a refund. So if your tax credit exceeds your taxable income, it's not refundable.
Do you lose that credit though, Rick?
Nope, it rolls. It rolls.
That's right. So what Rick is implying is if you don't utilize it, it's just going to continue to roll to the responding years. And then until you do have a tax liability, then you can wash it against that.
Yeah. So if you're one of those high income earners, and that doesn't take much, you could be a $200,000 earner, right?
Yep.
And every year you owe $10,000, $15,000. Look into solar.
Yeah, absolutely.
Yeah.
Good point. So we're on claim number 47 now. And on X, they're saying that NOLs, which stand for net operating losses, are now fully deductible. Is that true or is that false?
True. It is true with a caveat. So 80% of your taxable income used to be the cap. So let's say I had a $100,000 loss from a business that rolled onto my personal return, and the next year I had taxable income and I wanted to apply that $100,000 loss. I could only do 80% of my total income. Okay.
So you kick the can down the road for the other 20%.
That's right.
Yep.
Right. So that has now been removed. You can fully utilize your NOLs up to your taxable income and roll any unused portion forward.
I think that should have always been in play, to be honest with you.
Yeah. I mean, so I understand the point behind it was to keep people from generating a huge multi-million-dollar loss and then never having to pay taxes ever again. And it was like, no, we're going to limit you 80% so that you do have to pay taxes.
Yep.
But your problem with that is, what if you have income? What if you have $1 million loss one year, but then the next year you just make $100,000? Okay. Well, that means I can only take $80,000 of that $1 million loss, and I got to pay taxes on the $20,000.
Yeah. And if you had $1 million loss, I mean, you had some financial injuries there.
Correct.
Like that. Those aren't just paper numbers. Those are real losses that hit the pocketbook.
Yeah, and as someone that might go through that, you're like, I can't afford to not use this, right? So you are now going to get to fully utilize all those losses going forward. Okay,
love it.
Back on gambling, X says state taxes on gambling are now deductible. So I have to pay taxes. Louisiana has state taxes. Can I deduct my taxes on my gambling? True or false?
Yeah, that's true, actually, Rick. As long as it's within the $40,000 salt cap limit, and assuming you're itemizing, that's absolutely true. Yeah.
Nice.
Yeah. All right. So mortgage interest deduction is capped. This one right here is a pet peeve of mine. Okay, it's capped at $500,000. X says the deduction is capped at $500,000. We know that's fake news, right, Rick?
Yes. All right. So TCJA is the one that implemented this cap in the beginning, 2018.
Yep.
It used to be fully deductible. There was no cap. And in 2018, we put a cap on it and said, if you have a mortgage over $750,000, that was it. You could only take interest on the first $750,000 on a primary home.
That's right.
Right. It's not being cut back. It's not going down to 500,000. It is staying at the 750,000 amount. Now, do I like that? No, because properties have risen in value over the last 7 years, right?
Yeah, it should have been inflation adjusted.
And so we should have gotten an inflation adjustment. We did not.
Yep.
Okay. I would have liked to see this to go up to $1 million.
I would
have because of the fact that home prices are just more.
Yeah,
they are.
They are.
And so you're having to take out a bigger loan now.
That's right.
Okay?
That's right.
But it is false. There was not a cut on this.
Yeah. Unfortunately, we're not decision makers in this. We just have to report.
All right, last one. We've got X says that my fees as a tax preparer are now fully deductible. Is this true?
It is true. Miscellaneous deductions have been restored for Schedule C filers.
Okay.
So it is true. So look, hey, if you're looking for a tax professional, give us a call, reach out to us. We'd love to help you. Rick, I think we absolutely crushed on these 50 claims today. What do you think?
Yeah, I mean, look, the bill was huge, and we just got into the tax pieces in it. We didn't get into some of the economics and stuff like that. There's a whole lot more into it. But everyone needs to be mindful. Almost everything in this bill expires in 2028, which means in almost like 2.5 years, we're going to do this again. We're going to have a whole new set of changes in law.
Yeah, and to tap on a couple of things here, guys. So we did 50 slides, 27 truths, 20 fake news, and 3 half-truths. So what does that tell you? That tells you almost 50% is either fake or almost fake information that's out there. That's why I can't emphasize it enough. It is very important to reach out to your tax professional, your tax advisor, I would say. And look, don't get it twisted. Don't get caught up in the notion of who's ever preparing my taxes is competent to be my tax advisor. That's typically not part of that engagement. Yeah. That is a separate item. And typically those that can handle compliance aren't necessarily the best at advising.
Yeah. You got to be watching out on who it is that's preparing your taxes, because I'll be honest with you, not every CPA out there reads the bills.
No.
They don't. They might go to a conference once a year and learn this much about what's going on in the tax law. They're really relying on the software to catch any of the issues.
Yep.
And if you're just relying on the software, you could totally miss a deduction for a client.
Yeah, absolutely. And don't assume because the individual that is preparing your taxes is also looking out for your best interest in regards for advising. Not that they can or they can't do it. We don't know them, obviously, but you need to reach out to them and you need to say, hey, I want to book some time and I want to do some advising with you and really strategize. And that's more of a proactive approach. Look, don't wait till the end of the year. You should meet with your advisor at least twice a year.
Correct.
Twice a year, guys. Because your situation, whatever it might be, is very fluid. Also, be very careful if someone offers you some cookie cutter tax plan that's out there. Everything should be customized for you. That's the only way you're going to get the benefit. And that's the only way we do business here at LMY.
Correct. Yeah. Keep in mind, most of the stuff doesn't go into effect until next year, 2026. So if you're thinking that you're going to take advantage of some of these things right now, be careful.
Yep.
Okay.
Yep.
Don't go out and buy a bunch of stuff thinking I'm going to fully deduct it because you said I could. Well, no, it goes into effect 2026. Okay. That's the first thing. Second thing is because this bill has been put into place, if you currently do have a CPA, you should be scheduling a meeting with them right now.
That's right.
How's this going to affect my situation going through the rest of this year? And what do I need to get ready for 2026?
Yeah. And just to let everybody know, every tax professional, we have 2 busy seasons. We have a spring busy season and a fall busy season. If your accountant can't meet with you during the spring or the fall, that's a good thing. Okay.
Yeah.
That's a good thing. That means they're busy. That means they're coveted. Okay. If they have availability to advise with you in the spring or the fall, that means they're not busy.
Yeah.
You might want to find somebody who is busy and then book a session with that individual during non-busy season, during the summer, or after the fall season, around November or December.
Right.
Are great planning times to do these things. Low season for accountants.
Yeah, absolutely. Right now is our best time. We're meeting every day with a different client, talking to them about what their situation is, whether it's a business, whether it's an individual. This is the perfect time of the year because half the year is now over.
Yep.
So now we can do our projections to see where we think they're going to fall out and give them the best tax strategies that they need.
That's right.
Right.
That's right.
And so you should be doing the exact same thing with your preparer. And if you don't have one, give us a call. because we can help you.
Yeah, absolutely. You can look in our bio. Our website is lytaxadvisors.com or notaxdue.com. Both of them recycle back to the same website, or feel free to call us in the office at 281-288-0909. Love to help you. Thank you for your time today. Thank you for listening to us. This was another episode of the Entrepreneurial Blueprint Podcast. I'm Dr. Jake Latimer.
Rick Yancy.
We'd love to help you. Take care. Bye-bye.